Welcome to the 2014 Anti-Money Laundering or AML webinar presented by My Professional Educator. Your company is required to provide annual training on AML to its employees, and this webinar fulfills that requirement. In this webinar, you will learn the definition of money laundering and how it applies to mortgage banking, how to identify and respond to suspicious activity, basically something about the applicant or the application that you think requires investigation for fraud. Mortgage bankers and brokers are now required to report to the federal government their suspicions of fraud and money laundering on a suspicious activity report, also called a SAR. This webinar will last about 35 to 40 minutes and includes updates for 2014. The law itself hasn't been amended, so you probably remember most of this from previous training. My name is Jan Sofield. I'm an attorney with the law firm Levy & Watkinson and an instructor for My Professional Educator. Levy & Watkinson represents mortgage banker and broker companies and assists with licensing, compliance, and regulatory matters. My contact information is on this page. You may direct any questions to me by email after the webinar. A certificate of completion will be mailed to your employer. This is the outline of what we're going to be discussing. First, the background and laws that have to do with money laundering. Number 2, a definition of money laundering. Number 3, trends and issues for 2014. 4, how to identify suspicious activity. And 5, how to report it. In 1970, the Currency and Foreign Transactions Act, also known as the Bank Secrecy Act, was passed. The purpose was to require banks to make certain reports or records which could be useful in criminal, tax, or regulatory investigations. The law applied to banks, credit unions, casinos, security brokers and dealers, and money services businesses, which non-banks or a mortgage company is included in that definition of mortgage money services business. A residential mortgage lender and originator, or RMLO as they call it, is defined as a business that accepts a complete mortgage application or offers or negotiates the terms of a loan. So in other words, it applies to both mortgage bankers and brokers. That could be expanded, that definition, to include other types of loan and finance-related businesses. The Money Laundering Control Act of 1986 made money laundering a federal crime. FinCEN, or Financial Crimes Enforcement Network, was created as part of the U.S. Treasury Department administering the Bank Secrecy Act. The mission of that agency is to enhance the integrity of financial systems by facilitating the detection and deterrence of financial crimes. Then in 2001, the U.S. Patriot Act was passed. Transactions with anyone who commits, threatens to commit, or support terrorism was prohibited with this act. And as part of that, RMLOs, again, mortgage bankers and brokers, they were required to comply with the OFAC provision and customer ID procedures, but were exempt from AML programs and SAR reporting. AML and SAR reporting were included in that act, but did not apply to mortgage bankers and brokers. The Red Flags Rule was passed in 2008, and that required mortgage companies to have a policy to detect fraud. So your company should already have that rule, and that rule also applies to anti-money laundering because fraud in mortgage business is considered money laundering. In 2012, FinCEN decided to require RMLOs to have an anti-money laundering program and to file suspicious activity reports. They did a study to determine whether this should occur, and they decided that RMLOs are in a very unique position in mortgage origination because they are working closely with the borrower. They look at a lot of documents, and they are in a a position to identify money laundering risks. The final rule was published in February of 2012 with an effective date of April 2012, and the deadline for compliance was August 2012. Many of our clients are companies that only may have 1 or 2 or 10 employees, and they wonder if they are required to have an anti-money laundering program. And the answer is yes, because there is no exemption for the size of a company. What is the definition of money laundering? Money laundering is an activity where the purpose is to mask where the money came from or the source of the funds. For example, using a legitimate financial mechanism to make illegal activity appear legitimate. For example, obtaining a mortgage and using the proceeds, if it's a refinance, to fund some kind of illegal activity, or using money that was obtained illegally to buy property. So that is the way that anti-money laundering comes into the mortgage business. Common mortgage fraud schemes are property flipping, where the seller buys the property for a really low price and then sells it quickly for a much higher price. There's nothing wrong with that scenario, except that if the buyer submits falsified documents to the lender to obtain the loan, for example, a falsified appraisal report, income documents, etc., then it becomes money laundering. Another scheme is where there's 2 HUD-1 statements. One is given to the seller, having the actual sales price. A second one is produced at the same time that is given to the lender with the inflated sale price. And then the proceeds from getting the loan with the inflated sale price are divided among the co-conspirators. Another scheme is fraudulent qualifications, employment history, credit report, IRS tax returns, appraisals, and so on. These are the terms that's used in money laundering. Placement is introducing funds into banks. Layering is disguising the source of the funds by using layers of complex financial transactions that are going to be difficult for the average person to, figure out just by, a cursory look at it. Structuring is creating many transactions to avoid reporting requirements. For example, a bank is required to report cash deposits over $10,000. But if someone has $100,000 they want to deposit, they're going to make smaller transactions, maybe over a period of, days or weeks, 9,999 or something like that. Or maybe they're going to have multiple accounts that they're putting less than $10,000 in to avoid having the bank report the cash deposit. Integration is placing the proceeds back into the economy to appear legitimate. So if you have, for example, from a drug ring, you have, so illegally obtained funds from selling drugs, then you take that money and you put it into the economy by buying a business or purchasing a house. 2014 convictions. The IRS has a website where they publish some of their major convictions. And in 2014, so far, there have been 20 plus convictions for mortgage fraud. They all involved multiple conspirators, straw buyers, false applications, and other false and misleading statements. Most of these loans were closed in 2003 to 2008, and that's because it takes a while for the loan to go into foreclosure, perhaps, and then the investor starts investigating why this went wrong so they can blame the institution that sold the loan to them. And that's when you get a repurchase letter, and then perhaps something gets reported to the IRS. Lenders suffered a lot of financial loss when loans default. And the guilty parties, once they were finally convicted, altogether, these 20 scenarios were ordered to pay millions in restitution and several years in prison each. In 2013, the IRS convictions that were published, most of those had to do with using illegally obtained funds to buy property, luxury cars, jewelry, vacations, and a lot of it was obtained by laundering drug sales, such as cocaine, oxycodone, and heroin. One of the big ones in 2014 was Chase, where FinCEN assessed them a huge civil money penalty of $461 million for their participation in the Bernie Madoff Ponzi scheme. If you recall that, it's kind of a local thing. And altogether, the combined collection was $2.05 billion. And what happened with Chase is they had been involved with Bernie Madoff for over 20 years. And at times, they did internally investigate some suspicious activity that they noticed. Even the London office of Chase had reported activities that were suspicious to the, the London-based, equivalent of FinCEN, and reported it to the United States office of Chase. Still, Chase didn't do anything, even though they knew of the London reporting. They knew that there was possibly some suspicious activity going on, but they didn't report it. So they got nailed for not having an effective anti-money laundering program and not reporting their suspicions. In 2012, almost 70,000 of all SARs reported had to do with mortgage loan fraud. Most of the loans referenced originated in 2006 and 2007. Obviously, as I said before, it's often not discovered for years after origination. So that's why there's a lag. Foreclosure rescue also had to do with many of the 2012 SARs. Out of all the 2012 SARs, 83% were for purchase loans and refinance were 12%. These are the ranking of the states in 2013 of the number of SARs. California is number 1, and as you can see, New Jersey is number 7. Not something that our state can be proud of, but at least we're reporting them. One of the things that came out in 2014 from FinCEN was guidance on expectations regarding marijuana-related businesses. And basically their stance is that under the Controlled Substances Act, which is a federal act, it is still illegal to manufacture, distribute, or dispense marijuana. Nevertheless, 20 states and Washington, D.C., so that's 21 entities, have legalized medical marijuana usage and dispensaries, and New Jersey is one of them. So they've issued guidance on how to deal with, and this is basically for banks, a bank where one of these dispensaries or producers want to borrow money to fund their business. So because it is still a federally illegal activity, they've come up with 2 different SAR requirements. One is a marijuana limited SAR, and that's the lender believes, based on his due diligence of the company, that the business doesn't violate state law. So it's really what it says it is. They're a dispensary for medical usage of marijuana. On the other hand, if the lender believes that there is a violation of state law and it's really a front for other illegal drug activity besides medical marijuana, then you would file a marijuana priority SAR. So either way, if you ever come across something that has to do with a medical marijuana-based business, you need to file a SAR, even if you think it's legit. In 2013, FinCEN advised that there had been a significant increase in elder financial exploitation, usually perpetrated by a relative or other caregiver, where they're talking the victim, the senior citizen, into transactions that would benefit the perpetrator but, defraud the victim. Things like identity theft, embezzlement, check fraud, etc. So in the mortgage business, that would have to do with reverse mortgages or HECMs. So especially be diligent about reviewing these kind of applications when a power of attorney is involved. You want to really make sure that the person knows what they're getting into with a reverse mortgage. Insider abuse. This is again from 2013. This is one of the higher, the more prominent SAR filing is insider abuse, usually an employee. The most common thing is that they are engaging in some kind of fraud by submitting maybe an improper gift letter or using their influence to get an appraiser to increase the value on the house or other kind of misrepresentations. Brokers are also submitting false fraudulent information and misrepresentations just to push the loan through. That's considered money laundering and it needs to be reported. So now that our MLOs, mortgage bankers and brokers, are required to have an AML program, what does that consist of? Well, there are 4 pillars of the program. That's what they're calling it. And they're saying without one of these pillars, the program is not going to be able to survive. So you need all 4 of these factors. Number 1, you have to have the internal policies, procedures, and controls in place. There has to be a compliance officer. There has to be training of employees. And finally, an audit function to test the AML program. So I want to go over each of those 4 factors one by one. Number 1, internal policies and procedures regarding risk management, AML, red flags, OFAC, customer identity procedures, reviewing identified suspicious activity, maintaining records, and responding to law enforcement requests to provide information. You're probably familiar with the Office of Foreign Asset Control, or OFAC, requirement. You have to have a procedure to find out if the borrower appears on any lists of known terrorists, such as the OFAC list, the Special Designated National List, or Embargoed Countries and Regions list. So if the search does come up that their name is on the list, now it could be a common name, so you have to do a little further inquiry, but you would notify the compliance officer, deny the loan, file a report with OFAC, and OFAC does have a hotline that you can call. In reality, the mortgage companies don't really do this themselves. They contract it out to the title company. The title company runs the OFAC search, and you'll see that in the policy, the title policy. So if you're a processor or a underwriter, make sure that OFAC report is in there. Customer identification. Very important to have a procedure on how to do this. The standard is that the company must form a reasonable belief of the customer's true identity. You don't have to know for absolute certain, positive. It's just a reasonable belief. In other words, when they show you a government ID with their picture on it, unless it's really obvious that it's fraudulent, for example, there's no photo on it, or it's some kind of a document from a place that you never heard of and it doesn't look, something about it doesn't look right, you don't really have to go to take a step further, like, is this really a New Jersey driver's license? If you already know what a New Jersey driver's license looks like. So you would have to maintain a record of how you identified the borrower and keep copies of that documentation that he gave you. To verify the customer's identity, you can follow up by contacting the customer on his phone or his texting him or her, and comparing the information that the customer gave you with the information that's on the credit report, public database, or other employer. Check with the bank to make sure that the references check out. The second pillar is the compliance officer. He's somebody in the company who knows, about the mortgage industry, and he or she is responsible for the policy that the company has on anti-money laundering and updating it when there are amendments to the law or something comes out from FinCEN that you would need to add to the AML policy. It should be reviewed at least once a year. Make sure it's current. And the compliance officer should look for seminars or any other kind of designation that he could get if it becomes available. Maybe get onto some blogs or newsletters just to keep themselves current. The compliance officer may want to form an AML committee depending on the size of the company. If it's a company of only 20 people, you don't need a whole committee, you just need the one person. But if it's necessary to have a committee, you would have somebody from senior management as well as the compliance officer. And again, ongoing and annual employee training, developing relationships with vendors, states, agencies, etc. Develop internal procedures for suspicious activity reporting, and develop SAR reporting and record-keeping procedures. If the compliance officer needs assistance with some of the more technical aspects of being a compliance officer, they may want to designate a supervisor user who would be responsible for updating the BSA e-filing website and actually filing the SAR if it was necessary. And that supervisory user could create accounts for others if needed. They would also have knowledge of all the company's SAR filings in addition to the compliance officer, and that person would track the existing filings that have been done to see if there's any status updates. The third pillar is training, and that's required for any employee who would have a reasonable expectation of dealing with or being exposed to money laundering. And that would be, for example, you're looking at somebody like a processor who's looking at all the documents, same with the loan officer. Underwriter is looking even further at the documents, the bank accounts. They're all exposed to possible evidence of money laundering or fraud. New employees should actually be trained within 30 days of hire, and then existing employees are recommending a year every year. That training should include the fact that you need an anti-money laundering policy, the laws behind it, how anti-money laundering procedures are going to affect your job, red flags, how to respond to suspicious activity, and how you report to the compliance officer. The fourth pillar is the audit function. So the company must somehow test the AML program to see that it's actually working. It could be completed by an in-house employee or someone from the outside, but either way, it must be a person who is independent from the compliance officer. So they would go in and they would maybe interview a few people, ask questions, ask them who is the compliance officer in your company to see if they even know, see if they know anything about anti-money laundering and what their responsibilities are with that as far as reporting suspicions. And then the test would include looking at any SARs that have been filed to see if it was done properly on the system and that their record keeping is compliant. The FBI says there are two reasons that people would be motivated to commit fraud. One is when it's really just one person who wants to acquire one home for themselves, which is about 20% of all fraud cases. Usually there's just one loan, and they want to qualify the loan. They want to qualify for the loan, but they don't. So they inflate their income. They somehow get the appraiser to inflate, to adjust the property value. Maybe they're borrowing the down payment, but they're not disclosing that. There's debt they have that they're not putting on the application. They're lying about the occupancy. But once they get the loan, their main motive is they intend to repay the loan, but maybe down the road they can't, and then that's when the misrepresentations are going to come out eventually. But 80% of fraud is for profit. Usually there's a team of people that are working together on this, maybe the broker or the loan officer, the appraiser, the realtors, title agent, and notary. They're all kind of working together to make some money, and they have no intention of paying the loan once it closes. And that's why they're caught, because it goes into foreclosure quicker than the other, kind of fraud where it's just one person trying to acquire a home. It'll go into foreclosure almost immediately. Why is fraud being perpetrated more now than ever? In the past, it was the declining economy and declining housing values. That's still a factor too. But what's helped people who want to commit fraud is the great advances in technology. They've got greater access to information. They've got these scanners and computers that can reproduce documents, fraudulent documents. And then there are, the fact that you can apply online, that sometimes would help someone who's trying to commit fraud. Red flags for suspicious activity. This is part of the red flags rule, and this is something that you should already be aware of, but it bears repeating. As to the applicant, it's someone who provides misleading information or false information regarding the source of funds. Or they won't identify where they got their funds. That would automatically be a red flag if they can't substantiate where they got their money. Somehow you realize that they have some kind of questionable background. They don't really know, can't really tell you much about their business or industry if you had reason to ask. You notice that there are multiple bank accounts, and maybe some of the accounts are in different family members' names, or corporate entities that don't really seem to go along with the big picture. No apparent purpose for that. That could be a red flag. Or his cash flow and his assets don't seem to jive with what you know of his income or other resources. A lot of things on the credit report might point to fraud. There is actually a fraud alert on the account and notice of credit freeze. There's discrepancies in some of the data that is on the credit report compared to what he gave you. For example, the address. Last 90 days, increase in volume of inquiries. That could be a red flag for someone who is trying to buy two properties at the same time from using different lenders, and they don't know about each other. And those two applications, those properties are not going to show up on a credit report because they're too recent. Unusual number of recently established credit. That could go to what I was just talking about. Or he's changing the way he uses credit, or you see a lot of accounts closed for cause. That might make you wonder if he's a good candidate for a loan. If the identification documents that are given to you seem to be altered or forged, and you can tell that sometimes by the lines. Maybe they're a little wavy, or something about the way it's typed doesn't look right. Obviously, if the photo on the ID doesn't look like the person that you're dealing with, or any other inconsistencies, as we've talked about before, when you compare it to some of the data to the application for the credit report. On the application itself, the application information is altered or forged, or appears to be. Again, inconsistencies with the address, the social security number, and any other personal identification that he presents, or she. More red flags. The address is fictitious. Believe it or not, it's a bail drop or a prison. You can check the address of both the person and the property on Zillow and see what you come up with. Phone number, you try calling the person and it's invalid, or it's an answering service. They don't give you all the personal information that you've asked for, or you mail something to their address and it comes back undeliverable. All possible indications of fraud. You've got a short sale contract, and there's a clause that says the property can be sold quickly, within a certain number of days. You look at the appraised value, you are somewhat familiar with the area, but it just seems too high or too low. Or maybe you've looked on something like Zillow and it doesn't seem to jive. An unlicensed real estate agent or title agency, you can check, at least in New Jersey, you can check both of those things online. We have had that, especially with the title agency, where it's actually gone out of business, but they're still trying to do a few loans and then they take off with the money. Incomplete file documentation. Some more red flags. You get an application that is basically resubmitted, but they've changed some of the basic information. You would want to compare anything in your database for the same borrower to see if you already have something in there that you can compare it to. Maybe you'll get some third-party requests to pay for things like mortgage counseling, foreclosure avoidance. That would be a red flag, because a lot of those services they can get for free, and they should be getting for free. There's no particular, the borrower doesn't seem to know much about the property, which would be kind of weird. There's a huge down payment with no backup that you can identify. And again, large deposits on bank statements you need to inquire about. In August of 2012, this was right after the deadline for compliance, they issued an advisory just to highlight what common fraud schemes are in the mortgage industry, and that would have to do with occupancy, income appraisal, liability, debt elimination, and foreclosure rescue scams. And we see all of those, all of the above, in repurchase letters from investors. So obviously you're going to be looking out for things like that. Also in that same advisory, they highlighted Social Security number fraud, HECM, targeting seniors for trying to steal money from the senior, obviously without their knowledge, and employment fraud. So what do you do if you have a red flag and you suspect something is going wrong? You have to look at the big picture. You have to look at everything together, because there are different situations that can be explained. Not everything's going to be totally vanilla, and it may make sense when you put it all together, but you still need to take a look and possibly do further due diligence. Loan officers, processors, underwriters, and anyone else who suspects mortgage fraud, you notify the compliance officer. Maybe the compliance officer will develop an internal form that you can fill out and maybe put some backup with it, and give that to the compliance officer. The compliance officer would then conduct an investigation, possibly asking you to assist with it by gathering information that you need to, that he or she would need to do this investigation. The loan officer, processor, etc., would do the normal investigation that you might see with your job, but if that doesn't resolve your suspicion, then forward it to the compliance officer for further review. The compliance officer would then take that documentation and determine whether the SAR should be filed. If there's a supervisory user, the compliance officer can forward the SAR to that person to file on the website and maintain a record, keep some kind of filing system. When is your company required to file a SAR? When the company knows, suspects, or has reason to suspect. Okay? That doesn't mean always that you have proven it, just that you suspect that the transaction either A, or 1, involves funds derived from illegal activity, is designed to evade BSA requirements, has no business or lawful purpose, and really most importantly, involves the use of your company to facilitate criminal activity. If the dollar amount that you're talking about is $5,000 or more, that's when you must, and whether or not you've identified a suspect, it must be reported to FinCEN. And it should be filed within 30 days of detection of the suspicious activity. You can extend it to 60 days if you're still trying to identify a suspect. And this does not replace contacting law enforcement authorities. If someone has stolen money and you've found evidence of it, or if they're financing a terrorist activity, whatever it is that you would normally call the police, still do that, but also file the SAR. The exception to the dollar amount of $5,000 that I mentioned before is if it's insider abuse. So if the company believes that any employee, director, officer, agent, or vendor may have committed or aided in the commission of a crime, and the company is a victim, and it's a transaction involving any amount of money. So it could be $100. It doesn't matter. It doesn't have to meet the $5,000 threshold. It must be reported by the compliance officer to FinCEN on a SAR. An example of insider abuse that we have seen is a loan officer requesting the appraisal fee on a check with no payee written on the check, and then he later wrote his own name on the check and deposited it in his own account. And so maybe it was like 3 or 4 loans totaling maybe $3,000 that didn't meet the $5,000 requirement for any other kind of SAR, but with insider, it doesn't matter what the dollar amount is. As I said before, most insider abuse was committed by an employee. It could have also been a director or an owner of the company, or a vendor that you deal with. That's insider abuse. Or it could be that borrowers themselves altering documents prepared by an accountant, or those CPA letters for self-employed borrowers that says, I've been dealing with this person, I know that he has a business and I've been doing his finances. Those could be falsified. Or sometimes the borrower is an accountant himself or herself, and they provide false financial information on their own behalf. How do you file a SAR? Well, there's a website on the FinCEN website. I believe it's www.fincen.com. So the compliance officer goes in there and creates a FinCEN user ID and password, and then inputs information about the company and any individual profiles of either, of both himself, the compliance officer, and if there's a supervisor or user, they would both have a profile. The compliance officer would sign on to the FinCEN website, fill out the SAR form online, and submit. FinCEN sends back an acknowledgement, and then it can be tracked on the website as it goes along. What information do you put on the SAR? Well, there's 5 different sections. One is the company information, and that was kind of the header that the compliance officer set up in advance. The suspect information, name, address, occupation, date of birth, anything that you know about the suspect. If you don't know all of it, that's okay, just as much as you can. And how was that person related to your company? Were they a borrower? Is it an employee? And then what type of activity was involved, the amount of the loss, the dollar amount, and whether it was also reported to the police or the FBI or whatever. In 2013, they expanded that section to subdivide the type of activity of mortgage fraud so that you could also check off under that appraisal, loan modification, foreclosure, and reverse mortgage. The company contact information, that also was set up in advance by the compliance officer, so you don't have to fill that in again. And then section number 5, very important, a narrative format as complete as possible. Give all the details, documentation. I believe you can upload documentation so that when they look at it, they'll have all the information right there and can follow up on it. There are other reporting under the Anti-Money Laundering Act, Bank Secrecy Act. The IRS Form 8300, this is mostly for banks when there are cash payments of $10,000 or more in a trade or business. I don't think borrowers are going to come to the closing table with cash, but you never know. Currency transaction report, it's not required for an RMLO. And the FinCEN 314A is also for banks. That's asking banks to identify accounts and transactions that may have been involved in financing terrorism. And if 314B is also for banks, that's for sharing information between them. A SAR must be confidential. Even employees of your company, you can't discuss the existence of it. So you can't, talk to your cellmate or cubicle mate, I should say, or at the water cooler or whatever. Don't talk about this. You can't disclose it to the borrower, another employer, an investor, an attorney. If you get a subpoena for a SAR that cannot be responded to, what you should do instead is decline to produce the SAR, tell the compliance officer that someone's asking and who it is, and then the compliance officer will notify FinCEN that somebody was asking for a copy of the SAR. There is an exception to the confidentiality rule. You can report the existence of a SAR to FinCEN, obviously, to anyone who comes in to examine the company for compliance with Bank Secrecy Act. You can describe the facts about the SAR, the facts on which it's based, to another bank or another, if you're going to prepare a joint SAR with another bank. You can talk about what happened, you just can't say that you filed a SAR or a SAR was filed. There is a safe harbor. No one can come back and sue you for filing a SAR. The record retention requirement is 5 years. A copy of all SARs and the documentation are to be kept for 5 years, and that is different from the state requirement. For example, New Jersey requires 3-year retention for files, mortgage loan files. These you have to keep separate, the SAR file, and I would keep the loan file with it for 5 years. Who can examine the company for compliance with the anti-money laundering? FinCEN has delegated that authority to the IRS. That's why we talked before about IRS convictions. They are allowed to come in and examine mortgage companies for compliance with anti-money laundering. We have found that state examiners are now examining anti-money laundering programs during their routine examinations. Most recently, one of our clients had New Hampshire come in, and they looked at the policy, they looked at the training materials, they questioned people about who is the compliance officer for anti-money laundering. So be prepared for state examiners to examine the company for anti-money laundering. Monetary penalties can be assessed for not having a compliance program, not complying with it, for disclosing an SR when you're not supposed to, not having a program, and failure to identify and report suspicious activity that you could have identified. And going back to the example of Chase, they had an AML program, but it wasn't effective because even though they identified some suspicious activity, they failed to report it. So it's no good to have your program and your policy and everything else if you're not going to identify and report. How does this all affect your job? If you're a loan officer, you are the one who's probably talking to the borrower the most. Listen to what they have to say, look at the documentation, think about anti-money laundering when you're dealing with this person, and anything that you suspect, report it to the compliance officer. And when I'm saying avoid willful blindness, that means, like, well, I didn't see that. Let the processor find it. If the processor notices, then fine. Don't do that. Just report it to the compliance officer and let them deal with what should go on. Processors, again, same thing. Be diligent in reviewing. Ask borrowers questions about things. All of these things that you normally do, but just keep in mind that it needs to be filed on the SAR if there's any kind of suspicious activity. Same with underwriters. Ask the questions, report on suspicious activity to compliance officer. Closers. If there's a payoff of a previous loan, make sure it's to the correct party that the loan was. If they had a loan with Bank of America, don't be paying, preparing, make sure that the request for the payoff is to the right party. If there's third parties involved that they're asking checks for, that could be a red flag, so report it to the compliance officer. And that concludes the AML training. Thank you for attending. Again, my name is Jan Sofield. If you have any questions, please contact me. I'll be happy to discuss anything with you. Thank you.